Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn has made a nice move up into resistance and has now reached right into the middle of our target zone or target area near 392 to 393, and we have upward resistance potentially at 394.5. If this market's able to actually close above this 394.5 number this week, we can expect potential continued strength upside for corn, but the nice trend that we're seeing right now has been very consistent with the pattern that we've been looking for over the past few months. As we can see in the market now, the strength continues to come in very well. We'll continue to watch corn as it transitions through, but for now, we would not be surprised to see a bit of resistance overhead that causes the trend to pause just a little bit for the next week or so before the trend is potentially able to continue higher. We look for corn to continue to move higher till early April with minor corrections in between. The landscape suggests that 398.5 should be the next major level of resistance. And as we can see from the chart, the market actually has done well today to actually stop right up against our natural resistance downside angle. Upon breaking through there, once again, that 398.5 is perhaps a good area to have on hand for a potential target. And so until then, we'll wait to see how the market reacts at that level. Soybean futures are right at the throes of key resistance. And right now, we're looking at 1080 as a very critical zone for this July contract. This market actually looks to move higher if it's able to close above this level this week. A previous high that we're looking at sits at about 1096.25. And so above here, our target overhead would probably come in at about 1115 or so in the event that this market closes above 1080 this week. What we're looking at is very good resistance, and should the market turn back down over the course of the next few days, we would have a downside target sitting at about 1026. Right now, that 1080 number is going to be very critical for this particular contract. It has been holding very good support at each of the given natural support levels. The 1047 quarter that we discussed last week and the week before continues to hold up very well, and this is going to be a telltale level for this contract in the event it breaks down. Getting through this 1047 quarter again would lead to a potential target of 1026 at a minimum, with the possibility of coming down as much as $10. We've shared in the past about the significance of our red 1x1 angle, and that is in fact the angle that has given this market a bit of trouble at this time. As you can see, the most recent congestion of resistance landed right at that 1x1 angle. The market is testing it again, and so we're looking for the market to stay below for continued weakness and to get above for continued strength. It also continues to channel very well inside of two key zones. The top and bottom of the channel here we've outlined, and the mid zone of that channel happens to be right at that 1x1 angle. And so we would not be surprised to see the market to continue to channel inside of this zone. And once it's able to significantly break outside of the zone on either direction, this would be an area of potential increased volatility or increased strength upon breaking through that trend zone. We'll continue to monitor the zone very closely, but that's going to be two very important key levels for us to monitor. Moving on to July wheat, the key support level of 411 and 412 that we talked about on the March contract equates to 440.75 on the July contract. And the market came in and made a significant low near that January 31st timeline, from which the market actually bounced up, hit up against resistance, our 180-degree angle, came back down, but that key support above that 440.75 continued to hold. And our belief that the market looked to move higher did not disappoint. And last week, we finally got that breakthrough rally that we were looking for. In fact, the market has moved up very nicely, and we have a nice potential bullish consolidation here, which suggests that the market can trend a little bit higher. We have a minimum price objective of about 487, with the possibility of this market actually reaching up to about 499.5. In the event that it's able to close above 499.5, we would not be surprised to see a move that touches 515 and a quarter at a minimum. So right now for this July week contract, we're looking at some very important key thresholds that in the event that they break or the market's able to close above those levels, we're looking for continued strength and continued movement to the upside. Now, mind you, we do have a bit of resistance. Once we get to that 499.5 number, that's where our volatility-based resistance band lives. So the market wouldn't really need to clearly break through that 499 or essentially the 500 mark in order to really be able to move higher. But we are liking what we're seeing right now in the current patterns with the current impulse move that we saw with a nice little flag pattern that's setting up. And again, our minimum price objective for this contract sits at 487. From this view, we can see how a scaled division of the previous range gave us perfect resistance for this market. Again, right below, we also saw a bit of support coming in near that 443.25 mark. The market has since finally broken through after touching this resistance 3 times, and it's not uncommon for markets to actually be able to break the resistance after a test of 3 or 4 times. Upon reaching the 4th test, the market was able to break through, and now we're actually sitting just beyond our 1-by-1 angle, and now we have downside resistance overhead, but in all likelihood, the market looks to actually break through here and continue up slightly higher. We also have resistance overhead somewhere in the neighborhood of 502 to 503, and so that's consistent with what we're looking at with that 499.5 number being a very important threshold that could very well be difficult for it to get through. Once again, the trading band for crude oil continues to be that 56.25 down to 51.75. And right in the middle of that range is where this market has found very good resistance. It continues to trade on the downside of that range, and we continue to believe that in all likelihood, a move to the downside is probable. So at this point, what we're looking for is for this market to potentially break down inside the 52 number. Upon getting back down to about 52, we think a selling condition could very well exist here, which could send this market down to about $49. Upon breaking here around 52, then is now potentially a sell opportunity only because the trend that we've seen and the movement that we've seen for so long looks very much like a distribution pattern. And the last time we saw a break was a marginal break here, and it moved back up into the body of the trend, but the market was still unable to break above that midway point. And so this could very well be considered an initial false break, where initial takers tried to sell the market, got squeezed, but there was not enough buying momentum to send it higher to really consider it good strength. Since it failed at this halfway mark once again, the next time it breaks, what you'll probably see are the individuals that sold this initial break who got burned will be a lot more nervous. So as the market makes its way down, they will typically step aside from the next break, thinking that they're going to get jammed up again. And then this, in fact, becomes the break that actually lasts. And the market could very well now break below this 49 number since it's taken so long to get out of this range. Now, this will be the last week that we look at the March contract. We'll transition over to the next key crude oil contract with our analysis going forward. Prior to signing off today, we wanted to leave you with a handful of key support and resistance levels for the March contracts, since they have not come off the table as of yet. So for the March corn contract, we have key support at 372. In the event that the market were to break down below, we also have the next support level at 362.5. Overhead, we have key resistance potentially at 382. And above that number, a nice target projection of about 391.75. The key levels on the horizon for March beans rest overhead at 1102. And then just below that, very close where price is currently at 1069, downside support at 1036 and 3/4. And below that, we're looking at 1004 and 3/4. In closing, a quick look shows that wheat right now is currently right up against resistance at the 270-degree mark at 454 and 3/4. Next overhead resistance level is at 476 and 1/4, and downside support is at 433 and 3/4. So the area that we live in right now, once again, is a potential area of consolidation or flag pattern, where if the market's able to break up above that 454 and 3/4 number, or even 455, we could see this market actually make a nice little run up to about 476 and 1/4. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.